Hello, and thank you for joining us today for this seminar presented by our Pension and Financial Wellness Committee. Since ARTA was formed in 1963, we've focused on supporting our members in an engaged and active lifestyle in retirement. Our holistic approach includes one of the best retiree benefit plans in the country, as well as many additional programs and services, including our discount program, physical wellness events, social opportunities offered through our regional branches, scholarships for family members, and of course, seminars like this one. ARTA also serves as an advocate for teachers and retirees, using our collective voice to draw attention to the ATRF and teachers' pensions, the Seniors Drug Plan, the Choice in Education Act, and most recently, curriculum development. There are many different factors that allow ARTA to maintain such a wide reach. But in the end, it all boils down to our organization's financial wellness and sustainability. As a not-for-profit organization, ARTA takes any surpluses we generate and put them right back into the benefits plan. And because we were created by teachers, for retired teachers and like-minded professionals, we remain dedicated to retirees. 2021 has been a year of significant change for ARTA as we began to self-administer our benefit plans. While there have been hurdles to overcome in this transition, our dedicated staff have been working tirelessly to connect with each member and resolve independent, unique issues. While the initial transition was not as smooth as we would have hoped, we know that the long-term benefits of self-administration will be much worth these initial frustrations. With that, I will pass things off to the chair of ARTA's Pension and Financial Wellness Committee, Leo Richer.
Good afternoon. I am the chair of ARTA's Pension and Financial Wellness Committee. I'm joined today by Pension and Financial Wellness Committee members Blair Lowry, Sheila McKay, Ray Holger, ARTA's Vice President Deb Giroux, and by Lisa Sissons, our Executive Administrative Assistant. As you may have noticed, we have disabled attendee video and audio capability. This will ensure a quality experience for all participants by limiting web streaming. It also allows us to record this webinar for future use without breaching your privacy. With your audio muted, we encourage you to use the Q&A feature found at the bottom of your screen and submit your questions. You can submit questions publicly so that all attendees can see them, or submit them privately, and then only the ARTA staff will be able to see them. Our team or the speaker will respond to questions throughout the webinar. With those housekeeping matters completed, I am delighted to welcome today's speakers, Rod Matheson, Chief Executive Officer, and Julie Joyal, Vice President of Pension Services from the Alberta Teachers Retirement Fund. We are very pleased in having you speak to us about matters concerning our pensions. So Rod and Julie, I would like to pass the floor on to you.
All right, well, let me start, Leo, by saying thank you to you, the committee, and all the participants for this opportunity. We always enjoy the opportunity, look forward to the opportunity to speak to our members, our stakeholders, all our friends. This is good timing. Your request to provide an update on ATRF comes at a very good time in many respects. Our fiscal year end is August 31st, and that combined with some important decisions that were made by the board of ATRF at their December board meeting all has culminated in what is going to be the release of our annual report tomorrow. So part of our update today is going to be to provide you with a sneak peek of what's going to be shared with the broad membership and everybody on our website tomorrow. So I will cover few slides and talk about sort of the financial and investment highlights of the last year. I will also speak to another topic that is always of interest when we talk to members and to interested parties, and that's around the transition of our assets from ATRF to AIMCo for management by Alberta Investment Management Corporation. And then I'll pass it over to Julie, and she will share highlights around member services and also the recent actuarial results and speak to the funding or the funded status rather of our pension plan. And then I'll come back at the end and provide you again under the banner of an update. I thought maybe we'd share a little bit of some highlights around our new 5-year strategic plan that was approved in our last fiscal year by our board. So with that as a bit of an introduction, Julie, I think you're going to be driving the slides. So if you want to go to the next slide. And I'll speak to the investment results to start with. You can see from this chart that in our fiscal year end, as I mentioned, is August 31st, 2021. So keep that in mind when you look at these results, because anytime you talk about investment results, the end date is a very important point. You know, most people have December 31st year ends, and so you can't compare our results directly against, for example, other pension plans if they have a different year end than we have. But for our year ended of August 31st, 2021, our investment results, and this is the last year that ATRF was responsible for the investment management of the assets before we fully handed it off to AIMCo. The fund enjoyed a 15.6% overall rate of return, and that is relative to, or one way we look at that is relative to the benchmark that we've set for for the returns on the fund. So we outperformed, if you like, our benchmark over that last year. But more importantly, really for a pension plan, we always stress that pension plans are long-term investors, and what really matters is the long term. And you can see the results over both a rolling 4-year and 10-year period. Over the last 10 years, our fund has had a 10% rate of return, annual rate of return, compared to a benchmark of 9.2. So we've performed, performed better than our benchmark over the full 10-year period. Now, what does that mean as far as the pension plan? You can see from the chart at the bottom of the page, that shows the balance sheet, if you like, the size of the assets. We ended the year with $22.4 billion in assets at Alberta Teachers Retirement Fund. And you can see the slope of the curve, if you like. You can see over the past roughly decade or a little bit more than that, that steep slope in the curve. Now, of course, a lot of that is that, you know, the saying a rising tide floats all boats. Well, certainly we've all enjoyed over this last decade, with the exception of a little bit of a COVID glitch in 2020, but the capital markets have enjoyed a really strong bull run. So everybody has benefited from that. I would just observe that the slope of that curve for our pension plan is even steeper over that decade because of the fundamental changes that were made with the government of Alberta and the Alberta Teachers Association back in 2007 that really started to come into play right around 2009-10. And that was the changes. What it did was it resulted in our pension plan having significant positive cash flows because the contributions coming in for post-1992 benefits were significantly greater than the pension payments going out for those post-1992 benefits, because all of the pre-1992 benefits are paid entirely by the government of Alberta, 100% by the government of Alberta. So our plan, if you like, we refer to ourselves as the post-1992 pension plan. And for that plan, as I said, the cash flows coming in, the contributions coming in far exceeded the payments being made out to the tune of, in those earlier years, around 2010-11, about $500 million a year. So on a base of $5 billion, a positive cash flow of $500 million a year, rather, is a significant additional source of cash and helped us to really build the assets of the plan. So that's the snapshot. That's where we were as at the end of August. And the next slide is just a quick overview to show how the pension plan, the $22 billion of assets, is invested in the portfolio, if you like. This is not that different than if you looked at our annual report last year or received a presentation from us last year, you'll see that this hasn't changed much, and that's normal. Pension plans don't change their broad asset mix very often. We have just about half of the portfolio, 46%, invested in what we call return enhancing investments, which are equities, stocks, both publicly traded and private. That's where we get the significant amount of return, but that's also where there's more risk in the portfolio. It's always a trade-off. You want to achieve returns, but you have to do it recognizing and accepting the appropriate amount of risk. So just under half of our portfolio is invested in those somewhat riskier equity investments. The balance of the portfolio, as you can see, is invested in a combination of fixed income, which is bonds, and then some private assets like real estate and infrastructure. So that's a very quick overview of how the money was invested. Now I'm just going to turn for a minute to talk about the transition of our assets, the management of our assets to AIMCo. And this is something that I'm sure most people are well aware of. This was a massively complex exercise that we've undertaken over the last almost 2 years now. And it was required by legislation that we had to move the management of the assets of ATRF to AIMCo, to the Alberta Investment Management Corporation. By law, we had to have accomplished that by just this past December, by December 31st, 21. We established a plan with AIMCo early on in terms of how we were going to do that. I should point out that another thing that we did early on with AIMCo is come to an agreement that not only were we moving the assets, but we were also going to move all of the people at ATRF that were responsible for making the investments, move those people were all moved over to AIMCo as well. So here's the transition timeline that we'd agreed to with AIMCo. Early in 21, we did move the infrastructure, real estate, and private equity assets. So all of the private assets, if you like, that ATRF was managing, those were moved over to AIMCo. That was done in that sequence for a couple of reasons. Those were bigger, I'll call them chunkier assets, so it was easier in some respects to move them. Also, because the arrangement we have with AIMCo is those assets by their nature are, as I said, large, big assets invested in big projects or big funds. And those moved over to AIMCo, but they are being managed by AIMCo exclusively for ATRF's benefit, for the Teachers Pension Plan benefit, in what AIMCo calls segregated accounts. They didn't move into AIMCo's big pools of asset management. They're being preserved and managed exclusively for our benefit. So that, in a sense, made it easier as well to do that move. The balance of our assets, which were all of the publicly traded assets, that was an extremely complex process to move roughly $16 billion of assets that were invested, stocks and bonds, invested literally in markets around the world. Took a lot of organization and took a lot of lead time and planning to do that. And then, so we were able to successfully do that at the end of September, going into the beginning of October. By October 5th, we had completely moved all of the assets over to AIMCo. So they are now responsible for the day-to-day asset management of the entire $22 billion of ATRF assets. And I just want to point out that last bullet. As I said, this was an extremely complex transaction. Both we and AIMCo recognized from the very beginning this was going to be more complex than anything that AIMCo had ever done before. And I'm pleased to say that it was finished. We did it very efficiently, and we really focused on making sure that we did it at the lowest possible cost. Of course, there's going to be costs incurred whenever you do something like this, but we also focused on making sure that we did it efficiently and cost effectively. So with that, I think I stop now, and Julie will now walk you through some of the member services highlights.
Thank you, Ron. Before I do so, Ron, there was a few questions that if you could answer, at least one of them, I can take the other one. The question was, what is the benchmark result being compared to? So I'm going to go back to the benchmark slide and maybe just explain what our benchmarks are.
Certainly, happy to do that. And we do the same. I think this is a very common exercise, if you like, with investment funds or with pension plans. And that would be, we're trying to find a way to measure how much, what we like to say is value add we bring to the way the assets are managed. And so you measure how much value you've added by comparing yourself to a benchmark. So for example, an example that is often used is with respect to your stock portfolio. And if I take our stock portfolio and I say within that stock portfolio, we have stocks that we invest in the Canadian stock market. So what we would do is we would look at the returns of the TSX, the Canadian Broad Index. That would be our benchmark. We would say that a passive investor, if you like, that you could invest in that and earn those returns fairly easily. Where you really bring value as a manager of investments and of an equity portfolio, of a stock portfolio, is the job you do in picking the stocks that are better than what you'd earn if you just invested in the broad index. So in that case, the TSX, Toronto Stock Exchange, the TSX index becomes the benchmark we use to hold ourselves against when it comes to how we did in investing in Canadian equities. When it comes to our US equity portfolio, it would be against the broad Standard & Poor's index. We do the same kind of exercise. We have benchmarks we establish for all of the portfolios, for real estate, for private equity, and for infrastructure. And then we compare our actual investment results against those benchmarks. I hope that answers the question.
Thank you. There were two other questions that came up regarding the transition to AIMCo. One of them is, are all the ATRF staff with the pension still at AIMCo, or are they slowly being replaced?
They're not being replaced, I don't think, per se. However, the arrangement we had with AIMCo was that the ATRF staff would all be provided with positions at AIMCo that were, of comparable in areas of and of comparable sort of level of responsibility. But they only were provided that with surety, if you like, for 6 months. That was the deal that we came to with AIMCo. The 6 months has now passed for at least many of the first wave of employees that have gone over there. I'm happy to say that almost all of them are still there. There have been a few people that have parted ways with AIMCo, or AIMCo's parted ways with them, but they're very few. I think it's a handful. It's less than half a dozen people that are no longer still with AIMCo. So the vast majority of the ATRF staff, I'm pleased to say, are still at AIMCo, still helping to make sure that our assets are properly managed.
And the other question was, what were the costs involved in the transition?
Well, that's an interesting question, and one that we're still trying to sort out. As I said on the slide, you can't avoid costs. There's transactions costs. You're buying and selling stocks, and you're paying commissions, and you are paying legal fees to lawyers to help you organize very complex transfer of legal title of assets. So there are a number of costs. Maybe I'll just say there'll be a little bit of information in our annual report tomorrow on that topic, but a lot of it is more of a stay tuned answer, because a lot of that, as the slide says, a lot of our assets weren't moved until after the end of our last fiscal year. Those are the large ones and the complex ones, all the publicly traded assets. That we're still in the process of determining what the total cost of that piece of the transition was. So there'll be a little bit of more information in our annual report tomorrow, and then more to come down the road.
I'm sorry, they keep coming. AIMCo lost a lot of money at the beginning of last year. Does that affect us?
No, it does not. And if the reference is to the losses that made the headlines at AIMCo because of a particular investment strategy that they carried out that ended up resulting in significant losses to their clients, that was a strategy within their public equities product or portfolio. We were not a client of AIMCo at the time. When that event occurred, they were not managing any of ATRF's money. So the Alberta Teachers Pension Plan did not suffer the losses that sort of a lot of people focus on that occurred at AIMCo prior to when they started managing our money.
I follow up to the cost. Who pays for the costs?
Well, I mean, a significant portion of the costs incurred in this will be borne by the pension plan, effectively, by the teacher's pension plan.
And are assets going to be used to back the proposed Alberta Pension Fund? Very good question.
Very good question. The answer that we've asked that question as well, and the answer has been consistently no, and that AIMCo will manage, and AIMCo has already been managing the other Alberta Public Sector Pension Plan assets. So that would be the Local Authorities Plan, which has over 50 billion of assets. The Public Sector Pension Plan, which is the government employees, the government's management employee pension plan. Those have all been managed by AIMCo for a number of years. And then AIMCo does manage as well government funds. For example, the endowments like the Alberta Heritage Savings Trust Fund, and there's a number of other government directed funds. AIMCo manages them though on behalf of each client to meet that client's specific investment needs. They don't operate things on one large. It's not going to be the Alberta Pension Plan, and we've been assured our assets will not be merged with or become part of a larger Alberta Pension Plan. But that question would be one perhaps needed to be posed to the government.
There's one more coming. I think we're good on time, and I love those questions. And I'm sure Rod does too. So I'll just make sure to, we have kind of 3 sections of our presentation, so we're still good on time. I'll do the next one, but I may have to defer some to the end. So the last one I received is, if AIMCo suffers a similar loss going forward for a similar strategy that would then affect potentially our pensions, are they committed to a sound investment strategy that pension funds use?
They are indeed, and it was one of the things that I will say we really focused on as far as ensuring that we've put in all of the necessary, well, let me back up. The key thing that governs the relationship between ATRF and AIMCo is a document which is referred to as an investment management agreement, and that is the key document that governs how they're going to invest our money and all of the various reporting responsibilities and accountabilities that AIMCo has to us. And I'll also say that we were very careful to preserve that Alberta Teachers Retirement Fund maintains full accountability for and responsibility for the setting of the investment policy, the strategies, and the overall risk parameters that AIMCo has to operate within. We've now provided that to AIMCo, and with the investment management agreement, we've put in place the various mechanisms for us to be able to hold AIMCo accountable. So we've done whatever we can to provide the safeguards and the guardrails to ensure that we're comfortable with the way that AIMCo manages the Alberta Teachers Retirement Fund going forward. So we've done what we can.
Thank you, Rod. So I will start the next session. And good afternoon, everyone. It's always a pleasure to be here. And the timing is great. We usually do a presentation of that nature at your AGM in October. And at that time, numbers are a little bit stale because our fiscal year is August 31st. So we're kind of presenting almost a year-old numbers. But now they're fresh as they can be, out of the press. And those are our stats and our achievements and our results for the year 2020-2021. And of course, at the forefront of everything that we do, are members. So we have almost 85,000 members now, as you can see on the slides. 36% of them are retired members. And we're so proud of being there for you every day. So as you can see, the split, 42,000 active teachers, 30,000 and a bit retired members, and inactive members who are members that have service in the plan, that have funds accumulated, but are not necessarily accruing service yet, either because they have temporarily left the profession, the province, but they decide to leave the funds here, and either they're going to withdraw it later, restart accruing service in the province, or start their retirement when they're ready. So for a total of almost 85,000 members, and and we're very, very proud of being of service to all of them. We also have 96 employers. So those are the school boards, the charter school, private schools, and some locals, and the ATA, the Alberta Teachers Association staff. So 96 employers, and of note, we welcomed three new schools as of September 1st, and 2 of them are charters. So that was quite new, and we're very excited. And we do some projection in terms of trends, and we believe we're going to be almost 100,000 members by 2030. Those are projections from actuaries. Some of you may know I'm an actuary, so I can say that. And of course, things can change, but it's because we have some growth on the active teachers. But of course, our retired members are definitely where we're seeing a lot of good growth on the plan, and we need to project for that to make sure that we are structured for additional members, but also that we have the funds available to pay all of the benefits. I'll cover that with the funding section. A few stats. Like I said, I'm an actuary, I like numbers, so it's very busy, there's a lot, but this is kind of a teaser for our annual report. You'll find all of this information or an annual report and more. But those are the stats that sometimes we think you're interested by, just to see the average age of our retired members is now almost 73 years old. You can see that it's an increasing number, and that's normal because we have a growing population, but also longer life expectancy, people living longer, which is great news. The new retired members, so the ones that have just started their pension in last year, you can see the stats from last year are pretty stable for the last decade. Our average age of retirement is around 60, 59 to 60 years old, very constant. And they, on average, retire with 25 years of service in the pension plan. So that's quite remarkable. We have 96% of our members receiving a pension, so that means retired members that are either residing in Alberta or British Columbia. We do have a few outside the country, but definitely the bulk are staying local, which is great. And definitely the stats that we're very proud to share. Our oldest retired member is 103 years old and receiving their pension for 45 years. So congratulations for that achievement. And speaking of life expectancy, I'm just sharing here a few stats that are of interest. We did share it last year as well. We do experience studies, so we look at how our specific group of teachers and members in terms of their life expectancy, their termination, their retirement, and really reflecting that experience in the funding of the plan and doing those projections to see, well, how much money do we need to make sure that we can pay for their lifetime. And the great news for sure is that life expectancy continues to increase in the teaching population. You can see from the male perspective, the previous mortality table or life expectancy study was showing an expectancy of 22 years at 65. So that means someone could be expected to live 87 years old if they are 65 today. Then the new experience study is showing that the life expectancy had increased by almost 2 years for male members for 23.9. So a life expectancy of 89.8. Sorry, I don't have my numbers. 88.9. And the female also increasing, but it's a bit of a slower pace because they already had a little bit of an advance, as you can see. But the gap is narrowing. Female life expectancy used to have a bigger gap with male, and you see that it's getting closer, but definitely still a difference. So female life expectancy of 90.7 years old based on the previous experience study, and now it is 91.2. Sorry, I'm looking at questions at the same time, so I will keep that one for later. New retired members in the last 3 years, you can see that we are averaging around 1,100 new retired members every year. Pretty stable as well, a little bit of variation. So the last year was 1105, the year before 1147. And I'm just showing the trends per month. So in terms of retirement pattern, also pretty stable. You can see, of course, the peak of July at the end of the school year. But there's also a bit of a peak in February as well, kind of midterm, and some early retirement programs as well that are taking place at that point as of February 1st. We pay $88 million in pension every month. That's quite impressive. And it's, of course, a growing number. Last year or the year before, we reached a milestone of all the benefit payment, pension, termination, and others of $1 billion per year. I think we reached it last year or the year before, if I recall. So $1 billion per year is being paid in benefits. The average annual pension around $35,000 a year. So that's for all retired member combined. So of course, it really varies depending on since when they retired based on earnings at that point, service at that point. So it's an average of all the 30,000 retired members receiving their pension. And I should say that all of that is pre and post 1992. So from our perspective, from an administration perspective, we pay all service and we don't distinguish between pre and post 92. So it's one pension if you have service before and after. We administer all of them. It's just from a funding perspective, what Rod mentioned in terms of the pre-92, and I'll go back to that after. It's just from a funding perspective, the arrangement is different in terms of who pays for what. But from an administration, from a service, from what you receive as a retired member, it's combined pre and post 1992. It's all service that you've earned in the plan. Just a few things on what we do and how we connect with you and serve you. So communication is a big part of what we do and very important. I always take every opportunity that I have to reiterate the importance of staying connected both ways, us with you and you with us. So we have many ways to do that, many channels, many publications. One of them, of course, our annual report, as mentioned by Rod, hot off the press tomorrow, will be posted on our website. It's a great document to read about knowing what's happening with your pension, the funding status, our services, our investments. And then we have a summary of our annual report. We call it the highlights. And those are mailed for those that have decided to have a paper copy, but also can be accessible on our website. And those that have decided to have paperless for the environment, you will receive a notification in your email to say it's available, click here, and you can go on the website to read the highlights or the full report if you want. It's a very interesting read. Cost of living adjustment. You would have received in the last few days your annual statement. They were mailed on the 18th of January, so now we're the 26th. Most of you should have received it by now. If you received, if you decided a paper copy, so it would be by mail. But of course, they're always available early and very timely on My Pension. So that's your account secure portal on My Pension. You access them as soon as early January. You have your statement. You have how the cost of living adjustment is going to be impacting your pension. You have your tax slips available as well earlier than waiting for the mail. There's so many reasons to go on My Pension, register, to learn as quickly as you want, as conveniently as you want, whenever, 24 hours a day, 7 days a week. If you want to know more about My Pension or how to register, there's information on our website, and I really invite you to look at that. But of course, paper is always available, and if it's your preference, you can tell us that. In My Pension, you can go and say, I want paper or I want electronic for my statement or for my highlight or my tax slips. So those were mailed. Tax slips were mailed too, that I have to say, as of yesterday. That was much earlier than usual. We're so proud of that. So way before the deadline of February 28, as you know, all tax slips, the legislative deadline is February 28, but we mailed them yesterday, so you're going to have them in advance. So there's a lot going on in January and February, as you can see. I want to say a few words about COLA, because there was a question before. And COLA, so as mentioned here, it's cost of living adjustment. That's the acronym for COLA, cost of living adjustments. And that's a plan provision that some defined benefit plans have, like the teachers plan, have a COLA provision, or also we call it indexation or inflation protection. Not all defined benefit plans have a COLA provision, but we do. It's a partial COLA, but it's really it's an important feature of the plan. It does help with the cost of living and inflation protection. It's not 100% based on the plan provision that are decided by the plan sponsors, so the government and the Teachers Association. So the cost of living adjustment are 70% of the Alberta Consumer Price Index for service post-92, and it's 60% of the Alberta Consumer Price Index for service pre-92. So it's a partial COLA, so it's not 100%, but it's pretty good. So either 60% pre, 70% post-92. And what's also very important, and we put an article on our website just specifically for that, because right now inflation is a little bit, how can I say, not as stable as maybe we've seen in previous years. So what's important to know is that when we calculate COLA, it's an annual average. So we compare the price index in Alberta from 1 year average to the previous year average. So the COLA for this year, the Alberta Consumer Price Index, based on the calculation, results in 2.6% inflation, and then we apply the 70% or the 60% for pre or post. Whereas if you hear right now in the news, of course, it's more like 4%, 5% inflation, but those numbers, always remember, those are current month type of inflation. It's not the average of the last year over the average of the previous year. So when you take an average, you smooth it out, right? Like there's going to be some months that are peaking, but normally it's not permanent. Those higher inflation, normally it's stabilized back to, you know, that average 2% that our country is trying to target. But it's going to be moving from month to month, and that's okay. Sometimes it moves a little bit higher than what we are used to, but normally it should go down. And if it doesn't go down, or if it goes down much more, then the average will capture it at some point. But what we've been seeing in the last few months of higher inflation has not yet translated on the average, because it hasn't been a full year of that level of inflation. So what we are crediting on the pension as of January 1st, 2022 is based on the average of last year over the year before. And that's 2.6%. And then we apply the 60 and the 70%. I know it's a bit technical. I was not planning to do that here, but there was a question, and I think it's a really good one. And in fact, we kind of anticipated that question. That's why we've put an article on the website explaining exactly what I just said. So because it's a lot of information, if you want to go back on the website, read the article explaining why 2.6 versus what you're hearing right now, around 4 or 5%. And we always love to hear from you about everything that we do. So please write us at retiredmember@atrf.com. It's on the slide at the bottom. And for any suggestions, questions you might have. Speaking of website, if you haven't been since the fall, you might notice that it looks a bit different, but it's the same address, same address, atrf.com. That's the only address you need to remember. And you'll just see it's a new look and feel. and more accessible, and we're hoping easier to use and easier to find information. This is a bit of old news, but I'm not sure, who attended the last meeting. So I just want to mention again that we have direct deposit for all retired members, even those living outside of North America now. So we're really excited about that, because it's been something in the works for a long time, and quite not super easy, because we're dealing with not a lot of people outside of North America, but a lot of countries. A lot of different countries, and some with different rules. But now we're very proud to say that we're paying everybody by check, by direct deposit. No more checks, no more waiting in the mail, and no more it's lost somewhere between here and far away. And yep, staying in touch. That's the main message. It's so important to let us know if there's anything with your personal situation, your tax situation, your pension partner, your beneficiaries. Just make sure that your file is up to date. It's much easier when things happen. And the box at the bottom, it just, again, to reiterate, we are so proud to bring value, being efficient, and bring value at the best cost possible. And we do look at around us, our peers, and our cost of administration per member per year of 114 compares to 167 for our peer average. So we're very favorably positioned when it comes to providing value for service at an optimal cost. Funding. I'm looking at the question that there doesn't seem to be any on what I just covered. So I'll go to the funding and leave a few minutes also for sure for Rod at the end. So funding, as you know, the main goal of a pension plan is to pay benefits that are according to plan provision and that were accrued by plan members. And because it's a defined benefit plan, we pay pension for the retirement member's lifetime and maybe their pension partner, depending on the option they've selected. So it's not like we know in advance exactly how much will be paid, because it depends on how long you're going to live, how long your pension partner will live. It depends, like inflation. We don't know what inflation will be in the future either. So we need to make sure that we have enough money by making those projections, making assumptions, having risk management tools available, buffers or cushion. It's a bit like when you're doing your own budgeting. You need to make sure that you have enough money for the future, and it's not easy to plan, but we have people to do that, actuaries and other experts. And how is the plan funded? It's funded through contribution of active members and contributions from the government and employers. And you can see here it's approximately a 50-50 share between active members and the government and employers. Teachers are paying a little bit more because they have a little bit more inflation protection that they've decided to have post-92. That's the 70% versus 60%. And of course, a plan is funded through investments. That's a huge portion of the funding, but it's like your own savings. You're putting money aside, a certain amount, but of course you want that money to make money so that you don't have to put as much, but you put it early enough that your investment will make up the difference that you need. And that's what we do. We invest your money to make sure that we have enough to pay all the benefits, plus the contribution that we receive. The little difference for our plan, like Rod mentioned, is the pre-92. So the funding was different back then. The agreement that took place in 2007 made the arrangement different as well. What's important to remember is that the pre-92 service is currently paid by the government on what we call a pay-as-you-go. So what they do is they pay us. Let's say we say, oh, for all pre-92 service, we need X dollar per month to pay the benefits, and they give us that money. On their side, they put it on their books, for sure. It's a liability for them. It's an obligation. And they take the money from their general revenue. As to how it came about, the agreement, all of that, who was paying what before, did we pay enough? I know there was a question about that they didn't put enough money. That's why we're in that situation. That's why they have to keep the liability. There's a lot in there. I won't go there today because it will take more than 5 minutes for sure. There is information on our website on that, trying to understand a bit the historical event, the timeline that brought us to today's funding. But I can say one thing is that today's funding, that cost sharing, that funding management, the plan is being funded as it should, and government is paying what it should, teachers are paying what they should, and we have risk management tools, we have what we need, and of course we learn from past experience for sure. Defined benefits, I've learned a lot in the past years in terms of how can we make plans more sustainable and better funded and better equipped to ride the waves, because waves happen. We see that they will happen. That is a certainty. Is just when, how much, and are we prepared to face them? So pandemic is one, and we ride the wave, and we're in really good shape. In fact, we are in very good shape in terms of how do we know that? The health of the plan. We call it the funded status, or the funded ratio. So for the Teachers Pension Plan, which is the largest plan, we are very, very proud to say that we are 98% funded as of the last valuation, August 31st, 2021. So the path towards being fully funded is right there. We are on a steady path, and as you can see from the graph, it's been a constant positive trend of towards being fully funded, which would be a ratio of 100% or more. So 98%, in fact, it's 98.5, but couldn't put the decimal. And it's based on great investment return, sound management, having good risk management lever, cushion to weather the storms, and meeting our objectives of benefit security, contribution stability and affordability, and intergenerational equity. I'm really going fast. I just want to mention a little thing. The private school teachers pension plan is another plan that we administer for sure, very important, smaller in size, but this one is 107% funded, very good positioning as well, very healthy. And I'm just going to show briefly one last slide. Those are the teachers pension plan numbers. For the private school, if you want to see, it's going to be in the annual report, but this is kind of the balance sheet. So you can see the market value of 22 billion that Rod mentioned in the beginning. This is kind of a cushion for riding the wave or the storms, and the liability. So those are the obligation, our future obligation as of today. So today's dollar, the plan is expected to pay almost $21 billion in benefits as of today. So it doesn't include future benefits being accrued. So this is what we would have to pay, if nothing is accrued in the future, which brings us to a small deficit, or a deficit of 300 million, and for a funded ratio of 98%. What is it? Funded ratio, it's assets over liabilities. So we have, like I said, the goal is to have as much assets as liability for 100% ratio or more. So what I'll do quickly to see if there's any questions for me, or if it's all Rod. Rod, I think you really have the highlight today. So let me see. The next section would be the strat plan. So I think some of it would fit maybe what you're going to say. Do you want me to say the questions first?
If you think that makes sense, sure.
Okay. Have you read Robert Aska's work on AIMCo? I know that, but yeah, it's a yes. So the person is referring you to his report from the U of A, the 100 billion question, the title of the report.
Well, yes, indeed. I've read it. I think probably everybody on our executive and on our board at ATRF have read it. And for those who don't know, Bob Aska is a professor at he's with the Institute of Public Economics at the university. This paper, I believe, was actually commissioned by the Parkland Institute, but Bob was the author of the report. And if I remember right, the report was headed, "Can AIMCo be fixed?" And it was an analysis of AIMCo sort of post when AIMCo was created by the government and what their investment results have been. And it talks about and I don't have it in front of me, but it also speaks to the transition of, there's a piece in there about the transition of our asset management over to AIMCo. It ends up with a series of recommendations. The recommendations are around AIMCo's governance and ownership. And really the report would be targeted at AIMCo's board and at the government as the owner and shareholder of AIMCo. But sorry, to answer the question, yes, indeed, we certainly read with interest Professor Dr. Aska's report.
I guess I could take this one, but how will administrative costs be because of AIMCo?
Yeah, you're right. You could take it just as easily. That's a good question. Glad we can provide a little bit of clarification, because the administrative costs that Julie spoke about just a few minutes ago, we really look at the costs at ATRF in two distinct categories or buckets, if you like. There's the cost of administering the pension plan, the payment of the benefits, the support we provide to members along the way, and that's the administration of the pension plan. That's the $114. We measure that in a cost per member basis. The cost of investing is something that we measure as well, and we track that, and we always report on that in our annual report. And you'll see in our annual report, there'll be a detailed description of the cost of investing. It's multi-layered, because some of the costs to investing are easily determined because they're internal costs, the cost to us of our staff, and the cost that we pay for the various systems and things we pay to service providers. But then there are costs associated with hiring external investment managers, and we have to pay them fees. And sometimes their fees are based on whether or not they are successful and how much value they add. So they get performance fees. They only get the performance fees if they are successful and deliver value in how they invest. So in some respects, that's a funny cost, because we're actually quite happy if the performance fee portion of our total investment costs are going up, because what that means is we did well, and those investment managers did well on your behalf with your pensions. We got 80% or 90% of that value, and they got 10%. So, but it's a big number sometimes, but that's good if that means that it's because they did really well in how they invested. So there's far more information in our annual report that I'd invite you to go and have a look at, but they are distinct. So the administration costs versus investment costs.
I think the next one, it says private school plan is 107% funded. What is the extra 7% used for? What effect does it have on the plan? Very good question. So defined benefit plan, the goal is to be fully funded. Very rarely you're going to be at 100% and stay there. You always want to have some buffer because things can move. So you don't want to be so tight, then you're going to go in a deficit and have to pay for it and then back up. And so usually having a surplus is whatever is in excess of 100%. So in this case, 7% will be a surplus of 7%. Having a surplus in a defined benefit plan is a good thing, and it's normal, and it stays in the plan. The funds are in the plan; they're not used for anything else, and then it's another buffer. Of course, you don't want to have too much surplus, because then that's the generational equity that comes into play. Because then you have a generation that may be paid too much, and then it's the next generation that might benefit from it, or vice versa. You don't want to pay too little, because then you're going to create a deficit, and then the next generation will have to pay for it. So it's always being in that good range of 100 to 110% is a good place to be. If you go too much surplus, then yes, you should start doing something about it. what we call spending it. So using it for other means. So you could give a contribution holiday. You could de-risk the plan, so take a little bit less risk on the investment side. There is some plans that could do benefit improvement. It's I have to say less common these days because first of all, surplus are not that big, and also learning from experience is that if you put an increase in benefit permanently, well, it's going to come with a cost permanently. So it's all good to use some surplus to improve benefits, but at some point, either you're going to have to scale it back when the surplus is no longer there, or you're going to start to pay more to pay for that increased benefit. But benefit improvement could be one, but often you look at a temporary improvement that is not increasing your cost over the long term, but can use the surplus. So there are different ways. And like I said, it's not necessarily spending it right away. So that's 7% right now. It's in a good place. It's not about spending it. But if we were, increasing it, there's in fact, the maximum limit according to the income tax is 125%. That's where you really need to start spending it because it's the CRA, Canada Revenue Agency. They don't like when the money is tax sheltered for too long, as you know, from your RSP. So it's kind of the same for defined benefit. So need to spend it, but you don't have to spend it right away. Keeping it is a good thing as a buffer. And if you do spend it, there are different ways to do it. And that's the private school plan. The teachers plan have a little bit of a difference to it, but ultimately it should be managed the same way and allowing to have a surplus to be built from the plan. We're getting there. It's the first time we're potentially crossing that line of being in the surplus. The plan has never been in the surplus position from the get-go. So it's a new world for us, and for sure we're getting ready to manage surplus now instead of managing deficit. It's a good place to be. We have 3 minutes left. There's really good question coming through. What can we do? Rod, maybe spend a few minutes on the strat plan, and what we could do is see if there are questions that we can answer if you have a few more minutes. If not, we can do it in writing after the fact.
Sure, that'd be fine with me. And if there's enough time, I'm certainly available to wrap up and answer questions. I will be very brief on this, and I think we wanted to include this because I think it's just a nice, when we were asked to provide an update on ATRF, I thought this would be useful to share very briefly because our board went through a long process to do a new 5-year strategic plan. And I'm going to really touch on the highlights very briefly. It starts with basically validating or confirming what ATRF's mandate is. And it's really important, there's 2 distinct things. We must deliver the benefits that are established by the plan sponsors. The plan sponsors are the ATA and the government of Alberta. ATRF does not set the plan rules or the benefits, but we administer them, and we must deliver the benefits. And of course, it's table stakes. We must deliver them on time. They must be accurate. When you get your pension payments, you want them to be accurate. You want them to be deposited into the right bank account on the right day. When you come to us for information, you want that information to be accurate and timely. That's table stakes. The other part of our business is the board is charged with setting the contribution rates and investing the assets of the plan. And they do that in a way to make sure that we are sustainable in the long term, that we become and stay fully funded, but it has to be at a cost and risk level that's acceptable to the sponsors. So that was distilled down into 4 strategic imperatives. Retired English teachers in the crowd might like the alliteration that's involved in our 4 strategic imperatives. And Julie, if you go to the next one, I'm going to very quickly talk. I think it's important to talk about the excellence in funding and investment strategy, because I just want to remind everybody that we've moved the day-to-day management of the assets to AIMCo, but the Alberta Teachers Retirement Fund board still has responsibility as the fiduciaries and the stewards of the pension plan with respect to the investment policy and the high-level strategy and risk tolerances that we believe and that our board believes are appropriate to achieve those long-term objectives of being fully funded over the long term. We still do that at ATRF. That was a point of some contention between us and AIMCo, and it made some headlines in the media for a period of time because the government assured us and the finance minister assured ATRF and all of our members that ATRF would continue to be solely responsible for investment policy. And that is, in the long term, the most important factor when it comes to long-term success of a pension plan. How we decide how to invest the portfolio at the strategic level, how much to put into equities versus bonds versus real estate, and at what risk appetites. At that level, that's what drives the largest portion of success. What AIMCo does is they then take that and they implement that in accordance with all of the guardrails and safeguards that we've built into the investment management agreement. And their job is to invest it according to our investment policy. And we will keep a small group of investment professionals at ATRF that will be responsible for the development of the investment policies and overseeing the risks and the approach to risks at the total ATRF level. And we do that because Julie, if you go to the next slide, I'm just going to very quickly talk about those bullets near the bottom. We are the people, the only people uniquely positioned to understand not just the assets of our pension plan, but our reason for being is not to invest money. Our reason for being is to pay pension plan liabilities, to pay your pensions. So, and we are the only ones that properly understand all of the nature and the risks of those plan liabilities and the time horizon of the plan. We know what the cash flow needs are today and into the future, and that would drive how we should invest the money. And we're the ones who set the risk appetite. So that's a very critical role that ATRF will continue to play, and we will also monitor and provide oversight to AIMCo to ensure that they are investing it in accordance with our board-approved investment policy. That's what excellence in funding and investment strategy is all about. The next imperative, I think we can probably go by very quickly. The only other one, I think, in the interest of time, Julie, let's just go to the fourth one, because that's another one that we should speak to very quickly, and that is the fourth E, which is experiences to meet our member needs. I think you're generally aware that ATRF prides itself in the very solid results we get every time we survey our members. Members are very satisfied with the types of services, the level of service that they receive from ATRF, and we want to not only continue that, but improve on that. And it's all about the services we provide to members. And we are embarking on a very big project that is one of those once in a generational projects where we want to look at all of the people, the processes, and the systems and modernize them and future orient them and future proof them so that we continue to deliver the very high level of service that our members have come to expect from us. I'm going to stop there in the interest of time.
Well, Rod, this is Leo talking here, and before I do the closing, I would like you to know that we will be doing a giveaway for today's attendees. There will be two winners. If you'd like to enter, please send an email to contests@arta.net. That's contests, CONTESTS@arta.net, and provide your name, phone number, today's date, and the name of this session. So thank you so much, Rod and Julie, for presenting with us today. Our members certainly have had a lot of questions, and thank you for answering those questions and concerns so well.